Live from the Sky News City studio. Pre-Christmas gloom for retailers as shoppers cut back on non-essential items. Thames Water warns its turnaround will take time as it reports a big drop in half-year profits. Plus, the right kind of wrong. I'll be joined by the winner of this year's FT Schroeder's Business Book of the Year. Good morning, this is Business Live with me, Ian King. We begin today with some breaking news concerning the CBI. It comes courtesy of our city editor, Mark Kleinman, who joins me now. Mark, what have you got?
Yeah, that's right, Ian. The CBI, which of course has had a torrid year after a sexual misconduct scandal which brought it to the brink of collapse, is turning to Sir Winston Churchill's grandson to lead its revival. Now, the CBI has just confirmed a report by Sky News in the last 45 minutes or so that Rupert Soames, who's currently the chairman of the medical devices maker Smith & Nephew, will become its new president. He will take over from Brian McBride after the organisation's AGM next year. And of course, the CBI this year has had the most disastrous 12 months in its history. It was only rescued from outright financial collapse in September when it secured some emergency funding from a group of banks and corporate members. It said in its annual report, which was published just a few days ago, that it will need to renew that financing over the course of the next 12 months. But I suspect that members will regard Rupert Soames' appointment as something of a coup. He's a real business heavyweight in the UK, and it was an open question as to whether the CBI would be able to attract somebody of that calibre to replace Mr McBride. As I say, Ian, Mr Soames will take over after the AGM next June, and I suspect, as I say, that it will be regarded as something of an achievement, a triumph for the CBI to have attracted somebody of Rupert Soames' prestige to this job.
Great stuff. Thanks, Mark. Yeah, very big name indeed, Rupert Soames. Now, so-called Black Friday promotions appear to have done little to stimulate consumer spending as retailers continue to pin their hopes on a late rush for Christmas by shoppers. The British Retail Consortium said today that in the 4 weeks to the 25th of November, total retail sales rose by 2.7%. That was down from growth of 4.2% the same month last year. The British Retail Consortium said that once inflation was taken into account, it probably meant that retail sales had fallen during the period. Separately, the data and analytics company Kantar said it expects take-home grocery sales to surpass £13 billion for the first time ever this December. Its latest till roll data showed Tesco and Sainsbury's taking market share among the traditional big four supermarkets, largely at the expense of Asda. Meanwhile, Barclays has reported that consumer card spending grew by 2.9% in November, up from 2.6% in October. Joining me now is Esme Harwood, Director at Barclays. Esme, welcome to you. I'm finding it very difficult to reconcile the numbers that you put out today with those of the BRC. Help explain it to me.
Yes, of course. So I think first off, it's important to distinguish between essential and non-essential spending. So non-essential spending grew by 2.7% year on year. Some areas within that did pretty well. So if we look at examples like clothing or department stores, you can see that spend there has grown by 2.8% and 5% respectively. So there are certain elements within retail that have done pretty well. There are, however, other categories that have found November really tough, and a really good example there would be something like restaurants, where actually spend there is down over 11% as people kind of cut back and the weather gets a little bit colder. Then when we turn to essential spending, actually there is a bit of relief there for consumers. Inflation's going down, worries about food prices are going down, and so consumers there can be savvy and actually can choose to spend a little selectively. And real things like fuel prices going down has really helped consumers probably feel a little bit of that pressure easing on the essential side, giving them that little bit more leeway on the non-essential spend.
Now, you've picked up on an increase in confidence among consumers. That does bode well for Christmas.
Yes, it does. So confidence in people's ability to spend on non-discretionary items is actually the highest it's been since April this year. So there is a little cautious optimism coming through. And when we look ahead to Christmas, people in general think they'll spend around £100 more this year. And that's spread across a number of categories. Obviously, there's food and drink and the rising prices there over the course of this year. Perhaps that's not surprising. But it also relates to gifts and activities. So there does seem to be a little turning point in consumer sentiment there, such that people are looking forward to Christmas and maybe spending selectively and being savvy, but a little bit more than they did last year.
As you say, clothing sales did surprisingly well during the month. How much of that was weather-related, do you think?
Well, it's interesting, isn't it? Because although it feels quite cold and wet now, that weather actually took a little bit of time. So it was warmer maybe at the start of November than we were expecting and that we typically see. So what we think happened is that people were maybe put off buying new items just to that little bit later in the month. And that's worked out quite well for the clothing retailers. And it's also been a really good time for health and beauty, pharmacy. Spend there is up around 5%. So, where different providers are maybe launching seasonal gifts or brands, then actually that category has done very well as people look to sort of get ready for Christmas and maybe just get into that Christmas spirit a little bit early.
OK, Esme, got to leave it there. Appreciate you joining me today. Thank you. Some other business news stories for you now. And Thames Water said this morning that its turnaround will take time as it reported a big drop in half-year profits. The company, which supplies water and sewerage services to 15 million customers, reported a pre-tax profit of £246 million for the 6 months to the end of September. That was down 54% on the same period last year and largely reflected an increase in the cost of servicing its debt, which stood at £14.7 billion at the end of the period. Thames also highlighted a rise in bad debts from £36 million to £48 million. It said it was now supporting more than 335,000 households with paying their water bills, more than double the level at the start of 2020. Pub operator Marston's said today that Christmas trade looked promising, with bookings running ahead of this time last year. Marston's, which operates 1,400 pubs and owns a 40% stake in Carlsberg Marston's Brewing Company, was reporting an underlying pre-tax profit of £35.5 million for the year to the end of September. That was up 28% on last time. Marston said it was continuing to manage inflationary challenges within its control, with its electricity costs fixed until the end of September next year and its gas costs fixed until the end of March 2025. And the green fuel specialist Velocys has agreed to a £4.1 million takeover. The company, which emerged from a University of Oxford spin-out, is being bought by a consortium of investors led by the private equity firms Lightrock and Carbon Direct Capital. Others include a company backed by Temasek, the investment group owned by the government of Singapore. The consortium will provide up to $40 million worth of growth capital to Velocys as it seeks to work on sustainable aviation fuel production. Just going to break into the business news very momentarily. Breaking news from South Wales Police. They say emergency services are responding to a serious assault that took place on Moy Road, Aberfan, Merthyr, just before 10 past 9 this morning. Armed officers are in the area and request that people avoid the area so the police can effectively deal with the incident. More detail will follow as soon as possible. Now, the strong recovery in travel and tourism is not just delivering a boost to airlines and airport operators. SSP Group, which operates nearly 3,000 food and drink outlets in airports and railway stations around the world, is also benefiting. The company, whose brands include Upper Crust, Ritazza and Le Grand Comptoir, reported today that sales are back above pre-pandemic levels. Underlying earnings during the year to the end of September came in at £280 million, up from £142 million in the previous 12 months, and SSP has resumed paying dividends. I've been speaking with the Chief Executive, Patrick Coveney.
We've had a very good year in 23 of recovery. We had sales up 40% in the year. But you're right, the most pronounced sales growth would have been in North America and Asia, which now represents, more than half of the business in sales and EBITDA terms.
You're opening sites galore around the world. Which are the priorities for you?
Well, we're mainly opening in air. And so, in the year we've had, it's about extending the geographic footprint. So we entered Malaysia, we entered Abu Dhabi, and then we accessed 11 new airports in America. So we've gone from being in 38 airports at the start of the year to almost 50 now. So, that would be the main focus for us. And then the other thing I would say is that we're pushing the business more into bars and casual dining. So big units in big airports, basically.
What's driving that growth in US aviation? Are you taking over from existing operators, or is it the fact that these airports are finally being spruced up?
I think it's a bit of both. The first thing that's driving it everywhere is that people are traveling more, and especially traveling more for leisure. And when people are on a leisure mission or a holiday or going to see their family or whatever, they tend to go to airports a bit earlier, and they tend to spend more time and more dollars in bars and restaurants than they do if they're on a business trip. So that helps. But I think that the competitive environment in North America, one, you are seeing more airports being spruced up, and there's more funding going into improving travel infrastructure. And then secondly, we probably have a somewhat smaller number of competitors post-COVID than we had before. And the combination of those two things means there's good growth in the market, and we're also increasing our share.
If there is a blemish in the statement you've put out today, I guess it's UK Rail. You've obviously been affected by the strikes on and off over the last 12 months.
Yeah, well, I think there's two things I'd say about rail in both the UK and in our big, continental European markets of Germany and France, is that it has been a bit slower to come back than air has since COVID, and you've still got more working from home and a little less commuting than you have before. But then I think that effect has then been magnified for us by the strike action in the UK, and also the lesser level of industrial action in France and Germany.
Is it possible to put a number on how much that's cost you in the UK?
It probably cost us about 10 million of sales and close to 5 million of profit.
The one thing that really jumped out at me in the statement today is that more than a third of the meals you serve are now plant-based or vegetarian. You're ahead of your targets there.
We are. Now, I have to be balanced on that. That's the meals that we serve in brands that we own. I think the proportion of total sales that we would have that would be in plant-based food would be a little bit lower than that. But in general, we're pushing hard, both ourselves and with our brand partners, to have more sustainable food. And in fact, it's kind of opportune to say it with COP28 on in Dubai now, but in our units in Abu Dhabi, for example, we are now doing full carbon tracking of all of the items in our own brand units there.
What are you seeing on food inflation just now?
It's fallen off a bit. So, we had, in the year that's just finished, our food inflation probably ran, our total inflation that we had to put through in pricing probably ran at about 8%. It's about half that right now, 4%, say.
And obviously you employ 42,000 people around the world, including many thousands here in the UK. How much will the rise in the national living wage cost you?
Well, Ian, I've been pretty consistent on this. I'm supportive of that. I think we, across all of the societies in which we operate, seeing a strengthening of entry-level wages is just a good thing. Now, we have to manage the impact of that through how we put together, how we work, particularly the use of digital and the efficiencies that we get from that. And at times it impacts pricing, but you're never going to find me complaining or advocating for not supporting decent growth in entry-level wages.
Well, last night's reverse on Wall Street was followed by declines overnight for stocks in most of the Asia-Pacific region. The one exception isn't on the screen there. It's India, where all of the main stock indices hit record highs for a second consecutive session. That followed wins for the governing BJP in a number of state elections. Well, in Europe, stocks are pretty mixed right now, ahead of a lot of economic data releases this week. Talking points include Ericsson. It's ahead by nearly 7% after being chosen by AT&T to build a network for it under a 5-year deal that could be worth up to $14 billion. Nokia Nokia, which missed out on the contract, is down by 9.5%, as you can see. Well, here in London, trading was disrupted earlier this morning by a brief outage that affected small cap stocks. It didn't affect the FTSE 100, which is currently off 2/3%. The banks are weighing in the index, and in particular Barclays, which is off 2.5%. That's after Qatar moved to sell £510 million worth of its shareholding. Hong Kong and China exposed stocks are all lower as well. That's after Moody's cut its outlook on China's credit rating from stable to negative. That's hit the likes of Standard Chartered, HSBC, which is off of 1%, and Prudential. Outside the FTSE 100, or one of the standouts, is SSP, which we've just been talking to. Look at that, the share's up nearly 4% on that results statement. On the foreign exchange markets, the pound remains close to a 3-year high against the euro, but it's more or less unchanged against a single currency. Right now, it's off 0.1% against the dollar. As for the oil price, that's rallied after yesterday's sell-off, but it remains close to a 2-week low. Barrel of Brent crude currently changing hands at $78.13 a barrel. Meanwhile, the gold price, if you were watching yesterday, we mentioned that hit a record high, and on Friday as well. Little change today. An ounce of gold currently $2,000.23. Joining me today is Sanjeev Tumkar, Head of Equities at Rathbone Investment Management. Sanjeev, good to see you as ever. A lot of interesting company results outside the FTSE today. One that caught your eye was on the beach.
Yes, I think the travel sector has been a really interesting one to look at over the last 3 years. We saw that terrible death plunge for a lot of companies, in terms of Thomas Cook, for example, in 2020 when we saw COVID and everyone having to stop travel. On the beach, played it pretty well. They conserved their cash, did a small placing to raise some more money, and emerged the other side, and have been able to take a lot of market share, taking advantage of that vacuum that's been established when some of the bigger operators went under. So we've seen 19% revenue growth in the last full year. Current trading quite strong, so they're talking about 26% year-on-year growth since the end of their year, which is ending September. And they're very excited about winter bookings and next summer as well, which bodes well.
Shares were up 16% just as I was coming into the studio. Another one that caught your eye today, Moonpig.
Yes, another company that's really been buffeted around by COVID. So during COVID, as we know, we all stayed home. There was a big step up in e-commerce generally. That was certainly true of the cards market. Moonpig did very well to capitalise on that, gained significant sales growth and market share. They then IPO'd in the beginning of 2021 at quite a frothy tech valuation, so more than 40 years worth of projected earnings. And they did well for a while, but then we saw, as interest rates started to tick up, growth valuation started to really come under pressure. And even though their earnings held up reasonably well, the share price just suffered from a derating. So they got to a peak of nearly 50 years worth of earnings valuation, down to less than 10. They've now bounced a little bit since then, but it's a question of what you value the earnings of this company and what's the long-term growth potential.
Yeah, that's one hell of a correction, isn't it? Back up into the FTSE 100, we heard from Ashtead today, and not had an easy time of it lately.
No, they warned, I think 2 or 3 weeks ago, that their revenue growth wasn't going to be quite as good as they had thought. Interestingly, the debate around the US at the moment is clearly what's going on with the economy, with the impact of interest rates, what's going on with the construction market, which is typically quite cyclical. Now, they warned on the basis that they were seeing less demand for their services, which is basically renting out construction equipment. They saw less demand from the entertainment industry because of the actors and writers strike, and also less to do with helping out after major natural disasters. But actually, their core business of renting general construction equipment has actually held up very well. So it grew, I think, 14% in the last period. And they're still forecasting for their year ending next June to deliver 11 to 13% growth. So certainly they're not seeing any kind of significant downturn in construction. And longer term, they're looking forward to some of these mega projects that are potentially on the cards, with the federal projects that we've seen from the Biden administration totaling perhaps up to $2 trillion over the next 10 years.
Not to go for there. Sanjeev, you've got to leave it there. Good to see you as ever. Thank you.
Thank you.
Still to come here on Business Live, I'll be speaking to the winner of the Financial Times and Schroders Business Book of the Year about whether there's a right way to fail. Don't go away.
United Kingdom.
These last few years have seen some huge stories. And these stories have been driven by politics, by politicians, the people in power.
You must stay at home.
And it's my job to figure out how these decisions made by politicians impact all of us in our everyday lives.
This is the worst thing I've ever been through in my life.
People turn up here with their child stuff in a black sack and just say, I don't want to.
And that is what it is. It's first-class poverty.
Is this an example of the welfare state failing?
We take you to the heart of the stories that shape our world.
These are stories that affect us all. Millions of children are now having to catch up. Some stories have changed all of our lives. Because like the residents, the staff are being infected. Politicians, they make decisions all of the time, and it's our job to hold them to account.
I wonder if you will take this opportunity to apologise to those families.
But in the end, the real power doesn't actually lie with the politicians. The real power lies with the people. I'm Nick Martin. I'm the People and Politics correspondent at Sky News.
Slide Emirates, slide better. Fly Emirates, fly better. Thank you.
Welcome back. A reminder of the breaking news that we brought you a few minutes ago. South Wales police say armed officers are dealing with a major incident. A number of schools have said they are in lockdown as a precaution. That is in Aberfan. We'll have more on that as we get it. Now, is there a right way to fail? Well, apparently there is, according to the Harvard professor Amy Edmondson. Her book, Right Kind of Wrong, The Science of Failing Well, argues that although the idea of learning from failures is well accepted, few of us actually manage to do it. The book was last night crowned winner of the Financial Times and Schroders Business Book of the Year Award. Here's the book, and here's Amy Edmondson, who joins me now. Amy, welcome to you. Why don't we learn from our failures? Is it embarrassment?
It's embarrassment, shame, the desire to look good, not bad. We have an aversion to failure.
So how do we take emotion out of that process?
You know, I think that's well put. We take emotion out of that process as part of the answer. It's just pause to think rationally about what's really true, what you need to learn from it, and how to do better next time.
Now, your book's got some fantastic examples of people who did learn from their failing. And one that I particularly liked was Veuve Clicquot, the Champagne House.
Isn't that a great story? I loved that I could take a story of a woman born in 1777 and show how her extraordinary success included many failures along the way.
But if you look at this in the main, I mean, the one group I think that does come out quite well out of this is scientists and medics. They do seem better than others at learning from their errors. Why is that?
I think they're more comfortable with the idea that they're pioneers, that they're on the leading edge of some field where the only way forward is through experimenting, and with experiments comes the risk of failure.
Yeah, but I mean, quite often this is life and death. I mean, there's also a very good example in there of a little girl who was having heart surgery. She died, but others lived because of what the scientists learned.
Well, in those early days of cardiac surgery, indeed, there were more deaths than successes, and they never operated on a single patient who had a better option. And so they were only willing to operate on people whose lives were not going to continue because of a defect in their heart. So that's a way of mitigating the risk and advancing the knowledge at the same time.
Now, this is, I think I'm right in saying, the first time that a book specifically on management has won this prize. What would your message be to managers out there who think, well, hang on, we just want to move on to the next thing and carry on growing, not sort of sit and, ponder on our mistakes?
The only way to remain viable in a changing world is through innovation. And the only way to be successful at innovation is to be willing to fail. That means to be willing to have smart risks. So this is really a book about how to have smarter risks and then how to learn as much as possible from the failures that you inevitably will have.
But it's very interesting. I mean, people often say the US has so much more dynamic an economy than we do here in Europe and in the UK, because in the US it's acceptable to fail, and we still have hang-ups over that in Europe.
I think the acceptability of failure is a bit overstated in the US. It's not really true, right? I mean, most Americans would rather succeed than fail, and there's a kind of rhetoric about failure which is sometimes a little bit glib.
But it's fair to say, isn't it, though, that in the tech sector, I mean, sometimes they actually want to fail because they want to wear these as a sort of badge of honour.
But they'll generally be wearing that badge of honour after some success. Right? So you don't see people going out and saying, hey, I failed. You see people saying, here I am, I'm a big success, and let me tell you about my failures.
Is there any way that companies can build in a sort of failure measurement process into what they do?
Yes, I think they can be systematic about smart risk-taking. And that's explicitly in new territory, in pursuit of a goal, having done your homework so that you have a smart hypothesis, and keeping the size of the failure as small as possible.
Now, what do you make of the COVID inquiry going on in this country right now? Because it seems to me this is a classic example.
Yeah.
It's just a blame game. People are apportioning blame. People are trying to hide from their mistakes. There doesn't seem to be much analysis of what went wrong and how we can learn from it.
This is so important. It is absolutely essential to learn everything we can from our past failures. And it can't be a blame game. The goal of the learning can't be to find out who is at fault and punish them. The goal has to be to really understand, as analytically and rationally as possible, what happened so that we can do better next time. And that doesn't really work when everyone understands or believes the goal to be finger-pointing.
All right, Amy, we have to leave it there. Many congratulations on your victory, and
Thank you.
Hope you get a few more sales on the back of that. Thank you.
Thank you so much.
That's it from me. I'm back this afternoon at 4:30. Hope very much to see you then. Just to remind you of the breaking news story in Aberfan in South Wales, obviously a town touched with a tragic past. We'll have more on that after this short break with Jane Secker. Don't go away.